Jake buys a rental property. Tom puts the same money into index funds. But here's the part no one tells you. After 20 years, one of them will feel like they worked for money, and the other will feel like money worked for them. Both of them walk away thinking they made the smarter decision, but the reality is they're both missing something important. One of them underestimates the value of time, and the other underestimates the power of scale. And when you actually break this down over a 20-year period, the difference isn't just interesting, it's eye-opening. Let's keep everything equal so there's no bias. Jake and Tom both have $50,000 saved. They both earn $55,000 a year. Same age, same city, same financial starting line. The only thing that separates them is how they choose to use that $50,000. Jake decides to step into real estate. He uses the $50,000 as a 20% down payment on a $250,000 rental property, a simple 3-bedroom house in a decent area. He locks in a 30-year mortgage at 7%, which puts his monthly payment at roughly $1,330. After listing the property, he finds a tenant willing to pay $1,800 a month. On paper, that's about $470 left over every month. Before spending a single rupee on anything else, it already looks like a win. And emotionally, it feels even better. Jake now owns a physical asset. He has rent coming in. He has something to talk about. It feels real. Tom takes a completely different approach. He takes the same $50,000 and invests it into a total stock market index fund. No leverage, no property, no tenants. He sets up an automatic contribution of $300 every month and moves on with his life. When people ask him what he's investing in, he simply says, index funds. Most people don't react. Some nod. Some lose interest. There's no excitement, no story, no visible asset. On day one, Jake has a house, a tenant, and a sense of progress. Tom just has a number on a screen, and in the beginning, that difference in feeling matters a lot. But here's where most people get fooled. What looks like progress in the beginning can quietly become a trap later. For the first few years, Jake genuinely feels like he's winning. Rent hits his account every month. He drives past his property and reminds himself that he owns it. He benefits from tax deductions like mortgage interest and depreciation. Property values in his area slowly increase. Everything about the investment feels solid, visible, and intelligent. Tom, on the other hand, checks his portfolio occasionally. The number goes up, then down, then slightly higher again. Year one, maybe it grows to around $55,000. Year two, maybe $61,000. There's no excitement, no tangible proof, no external validation. From the outside, Jake looks like the clear winner, but numbers tell a different story. And this is the exact moment where most investors make the wrong conclusion, because they stop at what's visible and ignore what's actually happening underneath. Let's look at Jake's situation after 3 years. He's collected around $64,800 in rent. His mortgage payments total approximately $47,880. That leaves about $16,920 in what looks like profit. But that's not the real number, because now come the actual costs. Property taxes cost him roughly $3,000 per year. Insurance adds another $1,500 annually. A water heater replacement sets him back $1,200. A roof repair costs $2,800. At one point, the property sits vacant for a month, costing him $1,800 in lost rent, plus another $600 to prepare and relist the place. And since he manages everything himself to save money, he's also investing his own time, late-night calls, weekend showings, and constant coordination. After factoring in everything, Jake's real profit over 3 years drops to somewhere between $2,000 and $4,000. And that still doesn't include the value of his time. Meanwhile, Tom has invested his initial $50,000 plus $10,800 through monthly contributions. Assuming an average annual return of around 10%, his portfolio is now sitting close to $75,000. He didn't manage anything. He didn't fix anything. He didn't lose sleep over anything. But Jake still has one powerful advantage: leverage. And this is where things get dangerous. Because leverage can either make you look like a genius or expose every mistake you didn't plan for. His $250,000 property has likely appreciated to around $270,000 or even $280,000. His equity, the portion he actually owns, has grown to somewhere between $55,000 and $65,000. That's real wealth growth, and it's partly driven by using borrowed money. This is the part that makes real estate attractive, but there's something important people ignore. The rent number is not the real number. Because before Jake keeps any of that rent, multiple costs quietly eat into it. Vacancy is inevitable. Even one empty month per year means a full mortgage payment with no income. Maintenance is constant. A general rule is to set aside 1 to 2% of the property's value annually. On a $250,000 property, that's $2,500 to $5,000 every year. Then come major expenses: roof replacements, HVAC systems, plumbing failures. These aren't optional. They come in chunks of thousands, and they always come unexpectedly. If Jake hires a property manager, that's another 8 to 10% of rent gone. If he doesn't, he pays with his time. And then there's the risk of bad tenants, missed payments, legal delays, and months of lost income. None of this shows up in the $470 profit number, but all of it is real. By year 5, Jake understands this deeply. He's dealt with multiple tenants, rising costs, and unexpected repairs. His returns are still positive, but more realistic, somewhere around 3 to 5% after all expenses. Tom, meanwhile, continues doing nothing, and that's exactly why his portfolio keeps growing. And right here, the game quietly flips, but most people don't even notice it happening. By year 7, his investments have reached around $135,000 to $150,000. The growth is no longer slow. Compounding is starting to accelerate. This is where the real shift happens. Jake's growth is steady but effort-driven. Tom's growth is exponential and passive. By year 10, Jake's property is worth roughly $335,000 to $350,000. His remaining mortgage balance is about $166,000, giving him equity in the range of $170,000 to $180,000. Tom's portfolio sits at a similar level, around $165,000 to $180,000. At this point, they're nearly equal in net worth. But how they got there couldn't be more different. Jake invested time, effort, and energy. He also took on significant debt and concentrated risk in a single property. Tom diversified across thousands of companies and spent almost no time managing his investment. Now, fast forward to year 20. Jake's property is now worth somewhere between $450,000 and $500,000. His mortgage is nearly or fully paid off. His total equity falls in that same range. Over the years, he's earned rental income, but after accounting for all expenses, repairs, and upgrades, his total profit from cash flow may range between $40,000 and $80,000. Tom's portfolio, assuming the same 10% average return and consistent $300 monthly contributions, has grown to approximately $420,000 to $460,000. Out of that, only about $122,000 came from his own contributions. The rest is the result of compounding. When you compare their final net worth, they're in a similar range. But the experience is completely different. Jake worked consistently for his returns. Tom allowed time to work for his. Jake dealt with stress, management, and unpredictability. Tom dealt with market fluctuations, but had flexibility and liquidity. And here's the detail that changes everything. If Tom had increased his monthly contribution by just $200, bringing it to $500, his final portfolio would jump significantly, potentially reaching $550,000 to $600,000. That's the power of compounding combined with consistency. Increasing investment in stocks is simple. Increasing investment in real estate usually means buying another property and doubling responsibility. Now, to be fair, both strategies carry risk. Real estate involves maintenance, tenant issues, and illiquidity. Stocks involve volatility, market crashes, and emotional decision-making. Market downturns can be intense, and many investors panic at the worst possible time. Neither path is perfect, but both can work. Real estate performs well in strong rental markets, especially when managed properly and treated like a business. Stocks perform well when approached with discipline, patience, and long-term thinking. The real mistake isn't choosing one over the other. The real mistake is choosing without understanding the full picture. Because the decision isn't just about returns, it's about time,